Good afternoon, everybody. Welcome to the first quarter 2025 economic and market update call. I'm Greg Sweeney. Happy New Year to you. We have a little bit of a different format for today. We have a number of topics to move through. So the format today will be more dialogue based, less reliant on graphs than we have in the past. So with that, let's kick things off with a summary of how we see 2025 shaping up. We expect reasonable decisions from the Federal Reserve, continued deficit spending at the federal level, and pro-business policies supportive of economic growth in the United States once again in 2025 should bring about economic growth in the range of 2.5% to 3%. We don't see developed foreign economies participating in as much growth as we're seeing in the United States, with European and Japan probably being about half of our GDP growth, somewhere between 1 and 1.5, with the U.S. being 2.5% to 3%. There's a certain amount of anxiety that's attached to the incoming administration, wondering how their policies and programs are going to work. Consumers tend to respond to that anxiety by curtailing some spending. So if there is any pressure coming from the to the economy, we see it happening from the consumer standpoint. The consumer is about 2/3 of GDP in the U.S. economy. So if that uncertainty does prevail, the response is usually a reduction in consumer spending. So to sum up what we see happening in 2025, it would be, call it cautious optimism with some volatility probably mixed in. Growth, recent election results are expected to be pro-business and regulation light. To that extent, it should favor U.S. growth. As I mentioned, we see U.S. growth somewhere in the range of 2.5% to 3%. Developed foreign economies probably somewhere around 0.8 or 1%, up to about 1.5%. China still growing strong at 4.5%, but significantly less than they would like. The incoming U.S. administration could shake up European policies to make them more pro-growth in the intermediate term, but probably not as soon as 2025. Inflation, the markets see inflation as contained. We agree with that concept to the extent that contained inflation means inflation around 2.5% to 3% rather than the 2% Fed target rates. If we ask the Federal Reserve what their inflation expectations are, they're going to tell us 2%. The green line on this chart is the actual consumer price index, shows inflation at about 2.7%. And the red line is consumers' inflation expectations, and they're still currently running at about 5%. The reason for that is consumers see inflation quite a bit differently than economists see inflation. And the next chart I have for you shows how economists quote inflation. If you look at the left scale, inflation went all the way up to 9% and since come down to about 2.7%, which is where the CPI is today. And that's what you hear economists quote quite frequently is the current inflationary environment using the consumer price index, or CPI. But really what happens to consumers is inflation is cumulative. Those price increases that we've seen over the last 3 years keep building upon themselves. They don't start to go back down when we hear inflation going down. So when we hear inflation's at about 3%, it just simply means that a product we bought for $100 3 years ago is close to $120 today, and it's going to take another year for it to get up to $123. That's why inflation, particularly elevated inflation, is so much more detrimental to consumers than the actual headline rate of inflation being quoted by economists. And that can be seen in this chart using the right-hand scale for products that were $100 3 years ago and now are about $120. So that gives you a visual of why the consumers see inflation at a much different level than economists do. So back to our topics at hand. Monetary policy. This is the Federal Reserve. Their December rate announcement reduced the Fed funds rate by another 25 basis points. It also suggested some caution about the magnitude and the direction of further Federal Reserve interest rate cuts. Our expectation is maybe only 2 cuts on the Federal Reserve rate for 2025, one in the first half of the year of 25 basis points and one in the last half of the year by 25 basis points. This is a long ways away from what the market expected about a year ago when they were looking for 9 or 10 interest rate cuts by the Federal Reserve. By the time this is done, it'll be, I think, 6 if our 2 estimate cuts are correct for 2025. An argument can be made for actually fewer Federal Reserve interest rate cuts than even the 2 in 2025. And that's the last graph I have for you all. And that is how consistently the Fed funds rate lines up with the 2-year Treasury yield. Right now, the high end of the Fed funds rate is 4.5%. You'll see it. There's a very significant correlation between the Fed funds rate and the 2-year Treasury yield. In other words, the 2-year Treasury yield seems to do a pretty good job of anticipating where the Federal Reserve is going to go. And if we can see the 2-year Treasury is currently at about 4.25%, which would argue for only one more rate cut in all of 2025. So we wouldn't be surprised if that actually happens. Fiscal policy. This is congressional spending at the federal level. We are currently deficit spending at the rate of about 5 to 6% of GDP or gross domestic product. That tends to be a deficit spending level that's more consistent with recessionary periods, not periods of economic growth. And this is a concern not only for the U.S., but for most developed countries. At the same time, there appears to be very little political will to rein in this deficit spending. So we expect it to persist in 2025 in spite of the Department of Government Efficiency that has become known as DOGE. One of the reasons why the excess deficit spending is going to become a problem is because interest on the existing debt. Now, by way of example, there is $2.5 trillion of coupon debt coming due in 2025. So that does not include T-bills that are zero coupon bonds. This is what we call coupon debt maturing in 2025. The weighted average coupon of that debt is 2.55%. And there's a $69 billion interest bill attached annually to this $2.5 trillion of debt outstanding. That will be refinanced in 2025. If we do it at the current interest rate environment, it looks like it'll be about 4.5%, regardless of what the maturity structure looks like. The yield curve is fairly flat. That means the underlying interest payments on that same debt is going to go from $69 billion to about $116 billion. By way of example, again, that's just $2.5 trillion maturing in 2025. There's actually $36 trillion of government debt, to give you some idea of how much that interest expense could potentially be magnified. If the Department of Government Efficiency is successful in reducing spending by their $2 trillion target, we have some questions whether that's doable or not. But let's just say for a second it is. It will likely have a severe negative impact on the economy. The incoming administration is probably betting at that point that deregulation, tax cuts, and other measures will offset the economic shock. In this case, if that does happen, there will be a disconnect between the reduction in the spending and those policies taking effect. So there likely is a period of volatility or uncertainty, if you will, between when those budget cuts would come and when the other economic impacts would support economic growth. So don't be surprised about that if that disconnect does occur. Tariffs. Yes, there's a lot of talk about tariffs. Our position is that tariffs will be targeted and probably less aggressive and less disruptive than most people believe that they will be. Also keep in mind that a lot of countries already have tariffs on products that the U.S. exports to them, whereas they get to export their products to us, oftentimes without tariffs on them. The consumer, as I mentioned earlier, is 2/3 of economic growth in the United States. There's no shortage of commentary about how the consumer will continue to drive that growth within the United States. As we mentioned, we're a little bit more guarded in our confidence of what the consumer may or may not do. We see credit card debt, auto debt, consumer loan delinquencies, and other types of loan delinquencies increasing. The higher interest rates is definitely making it more difficult for consumers to maintain their payments, on top of the higher daily living expenses that come with elevated inflation rates. So at some point, we see both the elevated inflation and the elevated interest rates catching up with consumers and probably pointing to a slowing in their spending at some point in time. We don't know if that'll happen in 2025, but we definitely see it on the horizon. Stocks, the stock market, yes, we've come off a great couple of years. 2024 was about a 25% return in the S&P 500, probably one of the most popular indexes out there. Returns were in fact concentrated into a small handful of companies. If we look at the top 7 companies in the S&P 500, they generated about 21% of the 25% return in the S&P 500, leaving the other 493 companies generating 3.84% of the return, to be exact. So we're seeing the market rather concentrated in terms of its overall returns in 2024. We see 2025 as a point in time where those returns start to spread out beyond what's popularly become known as the Magnificent Seven. We think this is going to happen to those mid and small cap or the broader market stocks, because those broader market stocks have more attractive valuations than those popular 7 do in the S&P 500. We're less confident about other developed markets outside the United States participating in this economic expansion or market expansion, because most of this activity we see happening in the United States. What could we argue that would drive returns above our expected 10% return for the stock market in 2025? It would be a continuation of the AI, the artificial intelligence thematic theme, if you will, pushing it higher than our base case. At the same time, as I mentioned, deterioration in consumer spending and purchasing power and a weakening labor market could push returns below our 10% expectations for stock returns in 2025. With the bond market, income is back. The 10-year Treasury is about 4.7%. Right now, as I do this recording, we expect the yield curve to return to normally sloped. Normally sloped means higher interest rates, or longer-term interest rates are higher than shorter-term interest rates. It's in the range of expectations that interest income from bonds could provide about half of the return of the stock market. So just interest income on bonds being somewhere around 5% in terms of our 10%, in relation to 10% returns that we expect on the stock market. To that extent, anyone investing in bonds would get half the stock market return with significantly less volatility or less risk. Yes, the market value of those bonds could fluctuate too, but coupon income will offset that fluctuation. To help guard against market value fluctuations in bonds, we tend in our strategies to keep the duration shorter, which means that the portfolio is less sensitive to that changing interest rate environment. Credit spreads are tight. That's one of the incremental yield enhancers that we would look to make fixed income more attractive to our investors. We tend to favor right now mortgage bonds that have a more attractive and not only interest rate but credit quality. So to the extent that mortgages can add value, we like to look to those. We would argue that even though the Federal Reserve could potentially continue to lower short-term rates, it does not necessarily translate to lower long-term rates. So the fact that longer-term rates might be rising would not surprise us in 2025, although we don't see it rising a significant amount. Asset allocation, as I mentioned, it has been impressive to see the last couple of years returns on popular indexes like the S&P 500 and the NASDAQ. But they were concentrated, as I mentioned, in a few companies. Our January economic update, our written one that we put out on the website, covers this topic in more detail. So if you're looking for more information on that, I would encourage you to go look at that. Yes, I will say we've seen this before, right? We've seen these type of returns before, but we've never seen them last into perpetuity. So my point here is to avoid getting wrapped up into believing the stock market returns that we've seen over the last couple of years will be consistent moving forward. And to remind everyone, it's important to remain humble when it comes to long-term goals and building out portfolios to meet portfolio allocations to meet those long-term goals. Our direct strategies, our asset allocations are moving in the same direction as I've outlined in terms of our 2025 outlook. Our global stock strategy performed in line with its portfolio benchmark. Our fixed income strategy, as I mentioned, shorter than a lot of the popular benchmarks out there to protect against rising interest rates. They did indeed do that in 2024. Our fixed income strategy beat popular bond indexes by about a full 3%, and more duration matched or shorter duration indexes by over 1%. Our equity income strategy has become very popular over the years, particularly with people looking for generating income in a low interest rate environment and using stocks to do it. I'm pretty happy with the returns last year, about 6.5%. You might say, wow, that's terrible compared to the S&P 500. I don't disagree with you when you compare it to the S&P 500, but considering that the equity income strategy does not have any of the Magnificent Seven stocks in there because they're not attractive dividend payers, and you compare the dividend income strategy to the other 493 stocks in the S&P 500, we did about twice as well, twice as good as those remaining 493. So what else? Interestingly enough, the business of generating electricity is usually a sleepy business. It only grows by the amount of homes built and businesses opened within a utilities district. That doesn't seem to be the case anymore with the combination of data centers rolling out artificial intelligence computing capacity, in addition to blockchain technology, housing, and electrification of automobiles. Those three items combined, in addition to normal electricity demand from households and businesses, probably combine to basically need all of the electric generating capacities that are available, including coal. My point being is electric generation will not be nearly as sleepy as it has been over the past couple of decades for the next 3 to 5 years. In addition, I'd make the observation that because it's going to take all sorts of different electric generating capacities, that climate goals that have been put in place for the next 3 to 5 years are going to be very difficult, if not impossible, to meet. Mortgages, for those of you who are waiting for interest rates to go back down to 3%, probably is not going to happen, and probably might not happen again in our lifetimes. We went through an unusual period in the wake of the great financial crisis, where Federal Reserves are the equivalent of our Federal Reserve body around the world, at central banks around the world, use an ultra low interest rate environment to try and stimulate economic growth. Growth is back. Growth seems to be fairly entrenched again, and we probably don't see those type of interest rates ever again. Mortgage rates right now, we're looking for a range between 6 and 7%, which historically has been a pretty attractive range for mortgage rates as we look at the averages, excluding that 10 or 12 years or so in the wake of the great financial crisis. With that, I'm going to sign off. Hopefully I've done this in the 15-minute period we target. Thank you very much for your business, and wishing you a great 2025.